The coronavirus pandemic has negatively impacted millions of family companies, reducing and in some cases eliminating profits entirely. If there is cash in the business, perhaps from one of the government grants or funding options, and it needs to be withdrawn to cover living costs, then a lack of retained profits will affect how funds are withdrawn. One of the most popular tax-efficient strategies is to pay a small salary to directors, then withdraw any profits through dividends. In 2020-21, the most tax-efficient salary, where the employment allowance is not available, is £9,500. This is equal to the primary threshold for Class 1 national insurance purposes. If employment allowance is available, then the optimum salary is £12,500, equal to the personal allowance. Dividends can only be paid from retained profits. This means if no retained profits are available, then dividends can't be paid and another option is needed. Whilst profits are needed to pay dividends, profit is not needed to pay salaries or a bonus, meaning they can be paid even if this creates or increases a loss. Paying an extra amount of salary or bonus will come with a personal tax bill once the personal allowance has been used up. It will also result in employee and employer Class 1 national insurance costs where earnings exceed the thresholds. These are £9,500 and £8,788 respectively. It's important to remember that company directors have an annual earnings period for Class 1 national insurance purposes. One benefit of doing this is that salary payments and any employer national insurance contributions are deductible when working out the company's taxable profits. Rather than paying yourself a higher salary, you can also take a loan from the company. Most family companies are close companies. This means that if the loan is not repaid within 9 months and 1 day of the end of the accounting period that the loan was taken in, a Section 455 charge arises. This means that 32.5% of the outstanding balance must be paid by the company to HMRC. A benefit in kind tax charge will also apply if the loan balance tops £10,000 at any point in the tax year, even if it's just for a single day. The amount of tax charged is the interest that would be payable at the official rate, less any interest that has already been paid. The official rate is 2.25% from April 2020. Taking loans is particularly tax efficient if the outstanding balance is repaid before the Section 455 charge. An optimal time to take a loan would be when there is a difficult period for the business, but a return to profitability is anticipated, meaning a dividend can be declared to clear the outstanding loan balance. The provision of benefits in kind are also attractive, since the recipient will pay tax on the cash equivalent rather than meeting the full cost. Benefits in kind are also attractive when an exemption can be used to allow them to become tax-free. The trivial benefits exemption can also be put to use here, where the cost is less than £50 and the cost of trivial benefits is not more than £300 for the tax year. From the perspective of the company, Class 1 national insurance is payable on the cash equivalent amount. The cost of the benefit and national insurance cost are deductible when calculating taxable profit for corporation tax purposes. If you'd like to know any more, please get in touch with us. I hope that's useful. If you'd like to see more videos where we answer lots of questions on tax and accounts, take a look at our YouTube channel. You can also subscribe for more videos.